Hi, welcome to the webinar on entrepreneurship and machine learning and climate change. I'm Lynn Kagan. I'm a postdoc in the Energy Politics Group at ETH Zurich, where I'm working on climate change policy. Today, after a brief introduction to the two hosting organizations, Climate Change AI and Better Ventures, Jessica Eastling will present on funding milestones, early team formation, pitch deck structure, and fundraising best practices. Jessica is an associate at Better Ventures with experience in working across nonprofit foundations and social enterprises. This webinar is also hosted with the help of Alex Lacoste from Element AI. In the second half of the webinar, we are going to have a Q&A where you please write questions in the Q&A field and then upvote those questions that you like. And we will then read out those questions before we answer them. We will also record the webinar and make it available via email afterwards. So Alex and I are both members of Climate Change AI, which is an organization that aims to facilitate work at the nexus of climate change and machine learning. Climate Change AI currently consists of 12 researchers from mostly North America and Europe, and a number of senior advisors from machine learning and climate change related fields. And in particular, our mission is to enable impactful collaborations by connecting machine learning experts and experts working in areas relevant to climate change. And for example, we do that by organizing workshops at machine learning conferences, for example, at ICML or NeurIPS and Applied Machine Learning Days in Switzerland. And we also wrote a paper on how to use machine learning to mitigate climate change and also to adapt to the consequences of climate change. On our website, you can find that paper, an interactive summary of that paper, and also a page where we compiled further resources, such as dataset, for example. We also recently launched a forum for connecting people working in the space. Prior to this webinar, we have received a request to make a platform available where people attending this webinar could connect, and the forum would be the ideal place for that. So if you have any follow-up questions or want to connect to other entrepreneurs, please log on to that forum. And with that, I am going to hand over to Jessica Eastling for her introduction to Better Ventures.
Great. Thank you so much, Lynn. Everyone can hear me, yes? As Lynn mentioned, my name is Jessica Eastling, and I'm an associate at Better Ventures. Better Ventures is an early stage venture firm in Oakland, California. And we back mission-driven entrepreneurs who are leveraging breakthrough innovations in science and technology to build a better world. And so our three main focus areas that you may see on our website, if you visited previously or will in the future, are sustainable economy, data-driven health, and adaptive workforce. So we invest pretty broadly. We actually started as an accelerator program back in 2011 or 2012, still focused on helping and supporting early stage entrepreneurs who are using tech for good. We then, or fast forward to now, where we're now investing out of our third fund, which is 32 million. And I'll be diving into our investment criteria a little bit later in more detail, but we have about nearly 40 portfolio companies spread across those three areas that I mentioned. Our team is 4 people. We have 2 founding partners, Wes Selke and Rick Moss. And then we have 2 associates, so myself and another associate, Lindsay Bouchero. A little bit about my background before we dive in. So I studied interdisciplinary environmental systems at school at Stanford, where I got my bachelor's and master's. After graduating, I worked in a number of nonprofits and foundations that were focused either on conservation, environmental conservation, and or international development. And then I ended up working at a startup that's called Off-Grid Electric, or is now called Zola Electric, that focused on energy access in sub-Saharan Africa. And so they designed, manufactured, sold, and serviced small solar home systems to rural off-grid customers in sub-Saharan Africa. And I was there for nearly 4 years, where the bulk of my time was spent mostly launching new markets in West Africa. And so a little over a year ago, I joined the Better Ventures team. So moving from the operating startup side to now the investing in startup side, which has been really fun. And so kind of through some of the work that we do at Better Ventures, I was doing some research on how AI is being applied to climate change and helping with climate change solutions. That led me to the paper that Lynn mentioned. I would definitely encourage everyone to read it who's on this webinar. It's definitely going to be relevant to you. Ended up reaching out to the group, and we found that this might be a good webinar to put on for the community. And so what we're kind of the ideal audience, or who we were trying to target with this webinar, are people who are either thinking of or have recently started a company that is using a solution to a really technology-driven solution to help solve climate change. And so we're going to be covering, as Lynn mentioned, basically the basics and the basics of fundraising. And hopefully this will help people think through, if you are wanting to commercialize research or something that you've been working on, what are the first steps to going about that, and how to understand this landscape a little bit better, particularly on the venture capital side. So I'm going to start diving in. As Lynn mentioned, please, the way we're going to kind of answer questions is through the Q&A feature of Zoom. And so please type your questions in there, and we'll be answering them all at the end. But as I'm going through this material, feel free to start typing in there. Okay, I think I'll dive in. So there we go. So what I mean when I say that we are early stage venture firm is we function in this landscape. This is a little bit of a funnel that you can think of for the early stage. And so kind of that first bucket, the F&F stands for a friends and family round. That means that you're going to go to people you have previously worked with, or literally your friends and family who have money, extra money, who are willing to write you a check, not necessarily for your idea, but really as you as a person and you as a founder. That's really what they're going to be giving you money for, and in exchange for some equity in your business. Also at this stage, accelerators are extremely common. There is a very wide variety of accelerators across different geographies. There are some that will give you an amount of funding for an equity stake in your company, some ownership of your company. There are some that will give you money for then you to pay some of that money back to them for office space in their office. There are some that won't give you any funding, but will give you a lot of mentorship and content for you to build your business. And then of course there are grants that I'm sure a number of people on this call probably know a lot more about from the academic side, but we view non-dilutive capital, these grants, as really great for helping to de-risk technology before it comes to market. And so really making sure that it works. The ones that a lot of the companies we look at, some of the most common grants that we see are the SBIR, STTR grants. Our firm has good relationships with the Bay Area I-Corps node that exists here. We've built relationships with kind of the NSF SBIR team. We've been on panels to review some of those applications, and so we're definitely a big fan. And then kind of from there, the pre-seed area is where Better Ventures falls most strongly. And so this means kind of the first institutional round or investment that you will be receiving. And so that means an institutional firm rather than an angel investor, for example. An angel investor could be someone who participated in your friends and family round. Angel investors can also participate in the pre-seed, seed, Series A, etc. And really it's about those people adding strategic value. If you would like to talk a little bit more about what makes a good angel investor, please feel free to add that to the Q&A portion and we can dig in a little bit more. But so the pre-seed area, as I mentioned, is kind of first institutional money. We're going to talk about the specifics of each of these in a second. The seed is the next round where more institutionals, and then really the Series A is what kind of where probably we're all most familiar of hearing companies invest. And following Series A is Series B, Series C, D, E, and it could go all the way up to F and G these days. And then following that is really kind of what people call the exit, which is getting acquired by somebody and or going public, among some other things. And so let's kind of dive into the details of this quickly. So as I mentioned, kind of friends and family round, pre-seed, seed, and Series A. And so these are kind of about the round, averages of the round sizes that you should expect and the funding you should expect to raise at these stages. This continuously changes. So in the past, there was only a Series A and there wasn't any seed and pre-seed. Then there was a seed and now there's a pre-seed. And in the future, there will probably be something before the pre-seed. And basically all of these numbers are starting to trend to be bigger and bigger, hence why there are earlier and earlier rounds that are raised at a smaller amount. And so, as I mentioned, kind of Better Ventures focuses on this pre-seed stage. We invest at the seed sometimes as well. Okay, somebody said that they're seeing my video but not the slides. Is that true for everyone? Okay, you guys are seeing the slides. Okay, thank you. All right. So Dave, maybe message Lynn or Alex to see if they can help you. All right, so this is kind of the size of the rounds that you should expect at this stage. As I mentioned, these are changing. I'd be happy to provide some resources after this that kind of lay out the evolution of this a little bit more. But this is also how you can think of your team at this stage. So kind of friends and family, and also the pre-seed is really just what you would think of as two co-founders. And then you're starting to build your team slowly to really kind of complement each other. But at the Series A and past that is really when you're starting to scale and build your team out extremely quickly. On the market side, it kind of means that you have a hypothesis about the market around the friends and family and pre-seed round. You think you understand where there's a market gap and your solution can fill that gap. At the seed stage and the Series A, that's really when you've proven kind of through traction and people paying for your product or your service that there was a gap and you are filling it. And then you're really kind of taking advantage of that and starting to get market share at the Series A level and beyond. In terms of your product or service, really at the friends and family round, it's an idea stage. And so that's why I say people are really backing you more than kind of what you've produced. At the pre-seed level, when you start to talk to institutional investors, we typically expect there to be an MVP of a product. And so something that's bare bones that you're starting to test on the market or with some beta customers, and then turning that into really a version 1 for a few customers and moving on past there. So let me go and talk a little bit more about some of these pieces. And so Better Ventures focuses mostly on the business-to-business, B2B, and enterprise side, so selling to large kind of corporations or businesses. And so the number of customers we kind of expect to see at these places are as listed. For the pre-seed round, that's really where we expect kind of some pilots to be in motion. And so that means you have 1 to 3 customers who are hopefully paying for your services, probably for a small pilot level. And then from there to the seed, you're really turning those pilots into longer term contracts and also leveraging those to bring on new contracts as well. On the engagement side, this really means how your customers are engaging with your product. Are they just starting to? Are you showing really good engagement numbers? And then kind of as that trends over time. And so a lot of this means that over these different periods, you're strengthening your product market fit and really solving a problem for your customers. In terms of monthly recurring revenue, this is a little bit of what is expected. Again, this is flexible. It really depends on what your solution is and what your technology is and how you're pricing it. But these are just general numbers you can use as benchmarks. Same thing for kind of month-on-month growth. As for the business model, and we include impact in here since that's an area we're focused on, both at the friends and family and pre-seed round, these are still rough things. We expect when we invest that both of these will iterate over time to, again, find product market fit and really find a way to increase revenue and get recurring revenue streams. At the seed stage, this is where it's tested. So as I mentioned, you kind of have those pilot customers where you're testing out your business model, and then it has been tested, and you're then scaling that and iterating and clarifying that at the seed, and then Series A, you're getting ready for scale. And so the fundraise is just basically a reflection of kind of what was raised in the previous round, but this is a little bit of what you can expect. So I'll pause there. Here are the fundraising basics. And so a lot of people, or when you do go fundraising from venture capitalists, the most common way to begin that conversation is to build a presentation or a deck of including all of these aspects. And so this is not rocket science. You can find this resource a lot on the internet, probably all with different iterations, but these are definitely the basics that people kind of expect. And so the first one is problem, which is pretty obvious. But one thing that we see that we encourage people not to do is have 4 or 5 slides on your problem. Unless it's a very technical or new problem that most likely most people haven't heard of, then of course take some time to explain it. But typically it's best to try and be concise about that problem, because what people really care about learning is your solution. And so that's where you want to dig into how your product or service is directly solving that problem. You can show screenshots of what your product or service looks like. The more you can make it digestible and quickly understandable for the investor, for whoever's reading your deck, the better. Of course, you want to include some information on your team. So why are you the people to solve this problem? We get this question a lot about how should we include our advisors on the team slide. Our advice is basically that the people we're most interested in learning about are the people who are founding the company and working on it full time. Advisors, feel free to mention them, but it's not required. It's great to mention, especially if they're extremely strategic and are bringing a lot of value to the team, but not necessary. In terms of the market, this is where you want to articulate in dollar or whatever currency value, how big the market you're going after is. The typical business school terms for how you want to articulate your market is the total addressable market, the serviceable addressable market, and the serviceable obtainable market. And so it's TAM, SAM, SOM. And you can look that up online. It's very common. And that's one way where you can kind of break down how you're thinking about the market as a whole, but then again, the piece that you're specifically going after. That's a little bit of a top-down approach to articulating your market. You can also do a bottom-up approach, which is basically, here's how much we plan to charge our customers on average. Here's how many customers we expect to achieve or reach in however many years, and this is how much revenue we would get from those customers at that price point. Investors know that there are a lot of assumptions baked into your market sizing. We'll do our own market sizing exercises if we start to get into diligence. But the most important thing is to put a dollar value in that market slide. A lot of times we see ones that are, we're serving this many people, or, this is how many people don't have X. That's great, but you need to multiply that by some sort of dollar value. That's what the investors really care about. On the impact, that's something that, again, that we focus on, but not all investors do. You can include that depending on your audience. The business model, this is where you want to talk about either or both your go-to-market strategy. So how are you going to start to get customers? And then also, how are you going to be getting revenue from those customers? So what your pricing is going to look like in the beginning and over time, or segmented for different customers. Traction is where you want to talk about, if you have any revenue to date, who your customers are, and what your customer pipeline looks like. So you can talk about, as I mentioned, here are the few customers that we have pilots with. Here are the few that we are in deep conversations, hopefully getting to a contract soon. And then here are all the people we identified as high potential customers. And you can break it down in that way, especially if you don't have any revenue to date. And then the ask is always how you want to end your deck, which is basically, are you raising money? And if so, how much? And how is that money going to be used? You don't want to necessarily say how you're going to spend it. For example, we're going to hire this many people. You want to instead talk about the milestones that you're going to achieve with that money. So we are going to, get to version 2 of our product. We're going to get to this many customers, etc. And if you're not asking for funding, you can ask for connections to investors for building early relationships. You can ask for introductions to customers. You can say you're looking to hire XYZ person, and any warm leads would be welcome, but just include something that kind of brings your presentation or your deck to a close. And the reason that the team, market, and traction are highlighted is those are the 3 main things that especially at the early stage, investors really care about. They know that your business model is going to change. They know that your solution is going to iterate as you start to find product market fit. But it's really, who are the people building this? Do we believe in them? Is there a big enough market opportunity that they will be able to capture some of that? And then on the traction side, is it demonstrated that people are willing to pay for the product or service that you're putting forward? All right. So how to then go about, once you have your deck, what do you do? Really encourage everybody to leverage your network. And so LinkedIn is a beautiful tool that, you can really get connections to people and get secondary, third degree connections on there. A warm introduction to an investor is always better than a cold one. And so definitely recommend people spending time kind of asking for those from your network. Don't be shy. Cold introductions are also okay, but an investor is much more likely to pay attention to an email and a deck and be responsive if it's coming from someone they already know. So as much as possible, feel free to do this. I struggle with this one a little bit because it definitely creates some bias in the industry, but do it as much as you can. Unfortunately, that's how things work currently. A lot of investors do have open channels or emails where you can send things you can send things cold and they'll still review it over time. So ours, for example, I think is hello@better.vc. All right. To wrap up pretty quickly, I'm going to go through these next few slides so we can get to the Q&A. When you do send an email to investors, my main message here is keep it short and sweet. You don't want to write paragraph on paragraph on paragraph. You want to maybe write a sentence or two, maybe a few bullet points, and then wrap it up and include your deck, because most investors, myself included, since we look at so many of these, will open the email, skim it, and then click on the deck. And the deck is really what we pay attention to. Executive summaries, especially if you're attaching your deck, I don't think are necessary. It's great to have on hand in case somebody requests it, but definitely I would spend your time focused on the pitch deck. When you do get to the investor meeting, these are just some general best practices. I would say to arrive early. You don't want to get there 1 or 2 minutes beforehand and feel flustered. You were looking for parking, you're stressed. You want to try and get there, mentally prepare, be as composed as possible. Orchestrating the meeting. So, starting things off by how much time do we have? I just want to confirm. Feel free to kind of set the stage for what you're hoping to accomplish in that meeting. Don't be afraid to do that. Also try and make it a conversation as much as possible. We would say that when you do get to the meeting stage, you don't necessarily just want to give them a pitch presentation. They've likely reviewed your deck already. And so it's really about kind of feeling each other out as investor and an entrepreneur, seeing what that relationship could be like, answering the questions that aren't easily answered in the deck, and kind of making sure that you build some rapport. Asking how much time you have is always good. And then basically keeping track of that time to make sure that you have time at the end for the ask and to be able to ask the investor questions as well. You do, if even though you're not going through your pitch deck, we say that when you arrive early, pull up your slides and your deck on your computer and close it, so that if it does come up, you can very easily just open your computer and start going through. You don't want to, spend that time awkwardly connecting to the internet and you can't find the right file on your computer. You want to be prepared as possible. And then, if you have an hour, 45 minutes through, or 3/4 through your time, you definitely want to say, I think it's great if we would take some time to switch gears so that we can, talk about your impressions of what this looks like, and kind of get to the meaty part of the conversation. And then always make the close. This is something that I struggle with in my own life, but you don't want to leave without knowing how the meeting went, or how they understand, or what the impression of your company is. And so here are some phrases you can use to make that close. How does this sound to you? I'd love to get your thoughts on what we're working on. What's your level of interest? What's your typical check size? How does this fit into what you're looking for? So you basically want to start to get the investor talking, start to have them shift in their mind of thinking through, if I was to invest in this company, what would it look like? Just to kind of make sure that you're leaving that room with a better understanding of where you stand. All right. And then just to kind of wrap up in this last minute of what our specific criteria are. So we look for 2 or more founders, with at least one of those founders being technical. As I mentioned, our 3 areas, we want to see big impact in one of those. We focus on these breakthrough innovations in science and technology. We don't really do hardware or capital intensive investments, but so we focus a little bit more on software and data science and some life sciences as well. As I mentioned, we kind of like to be the first institutional check-in. So at the pre-seed stage, we sometimes do seed investments as well. We really focus on kind of domestic investing, but we do have some international investments. We really push for all teams to be co-located in the same place. So we know that there are a lot of tools out there, but we've found a lot of value in our experience for teams to be, at least in the early stages, all in person together. And as I also mentioned, we focus a little bit more on the enterprise and B2B. So I welcome everyone. This is my LinkedIn to connect there, especially if you want to continue the conversation after this webinar. So I think now we'll move into the Q&A portion. If anybody had any problems, this is where you can find the Q&A. I'm not sure if you can see it there. And then in the Q&A box, you can see this is where you can upvote questions. I believe that we'll be answering the highest voted questions first. But I will pause there, and now it's open. And I'll have Lynn kind of read through those.
Okay, so we have 2 fairly related questions that are came up first. They are, how do you figure out how much equity you give investors at each funding milestone, and how much equity has to be typically offered at each round?
That's a great question. So I'm just going to kind of jump back to this area. So the equity piece is really going to be answered by what the valuation for that company is going to be at that stage. The reason we don't have that here is because that's something that definitely is a negotiating piece between the investors and the entrepreneur. It also really depends on the type of company it is. It depends on how much traction you have, if the founding team is first time or second time founders, the market, etc. And so, but what we are starting to see, we invest really in companies that have less than a 10 million post-money valuation. And how I can break that down is when we invest at the pre-seed level, we are targeting 10% stake in a company. And so that means if we invest $1 million, that with a $10 million post-money valuation, that would help us get 10%. I think that what we're seeing these days is that the seed level, lots and lots of seed companies are reaching this 10 million post-money valuation, sometimes even more. I talked to a company recently who had a $35 million pre-money valuation in the seed stage. That's like on one extreme end of the spectrum. And so I would say, you know, at the pre-seed stage, we're typically the only or the one of 2 or 3 investors at this stage. And so if we're targeting 10%, we like to lead, which means we like to put the biggest check in. You can imagine that others would own less than 10%, but you can kind of build up from there. I hope that helps.
Okay, the next question is, will you invest outside of California?
Yes. We will. So we have a little bit of a preference for companies that are based here in the Bay Area because we like to be face-to-face with our teams. But we invest outside of California, across the US. We also have a number of investments that are international outside of the US. We're more likely to invest domestically in the US, even more so kind of here locally. But we don't have kind of strict requirements around that.
What are some of the countries? Do you know?
So we have a few investments that are in the African continent. I don't think that we have any in Europe currently, but we do look at companies there from time to time. South America, I don't believe we have any investments, though one of our companies is focused or launching something in Mexico. I don't believe we have any investments in Canada, and then Asia, we don't as well. I'm probably forgetting some continent, but that covers where our investments are currently.
Okay, can you share your philosophy on why you insist on a co-located team?
Sure. This is a little bit more from experience than anything else. And really what we're focused on is the founders themselves being in the same place. This might be a little bit of the old school view or the old school nature, and maybe this will change over time, but we just have seen with our co-located founders and founders that are not co-located, things, anecdotally going better for the ones that are. We think that it allows, much better back and forth and immediate problem solving. Also at the same time, building culture at such the early stage and building the foundations for your team culture are really, really important. And that's more easily done when it's in person.
The next question is from a consultant interested in helping high-impact startups get MVP and V1 software solutions built. Mm-hmm. The question is it worth to reach out to purpose-aligned VCs for introductions to their portfolio companies, or should I reach out to prospective clients directly?
That's a really good question. I would this is maybe not a super helpful answer, but I would encourage you to do both, particularly if you have a relationship with purpose-aligned VCs, and a warm relationship. That I think is a really good place to start. On both sides, it's going to be a little opportunistic. So if we have a company in our portfolio that let us know we're looking for this type of support, then of course we're going to be like, okay, great, we're going to introduce you. And I think it's the same kind of on the client side. Probably for economies of scale, reaching out to VCs might be a little easier, but VCs are notoriously unresponsive and overloaded with email and such. And so you might have a better hit rate of reaching those people. I would also say kind of helping the stage that you're talking about, this MVP and V1 software solutions. A lot of time that's going to be at this really, really early stage. And so I would also encourage you to, as it mentioned previously, kind of lean on your networks for that. Those people are probably not going to have a ton of funding to be able to pay for a high level consultant. And also on the investor side, or when you are so involved at that early stage, I would encourage you to maybe think about being a co-founder if you get really involved with a team. As an investor, the reason that we require for at least one of the founders to be technical is because we really want that person to be the one who's building the MVP of the product, because we want to know that they understand it inside and out. They're building it for scale, with scale in mind, for future scale in mind. And things that are outsourced, there's just less quality control there. And so just also want you to have that context and perspective, if that's helpful. Hopefully that answered your question.
Okay, the next question is on what specific challenges and opportunities associated with founding and running startups in the climate change space are there and which may not exist for other startups?
That's a really good question. And one that I struggle with because I want to find us companies in this space, but a very typical challenge that a climate change solution startup kind of comes up against is the people who are going to pay for that product or service are typically going to do it out of the goodness of their heart rather than for a business imperative. And so unfortunately, how our current economic system works is that people are driven by money. And so unless something is really allowing them to make a lot more money or save a lot more money in their costs, they're less inclined to move forward with those activities, right? And so if you're a small business or a large business, when you're choosing to do something that reduces your climate change impact, so reduces your emissions, the people who are going to be signing up to do that are going to be kind of the early adopters who have carbon neutral policies, who have made public promises to reach a certain emissions goal at a certain time. But a lot of the financial incentives are not necessarily aligned currently for people to do that, especially here in the United States because of our lack of policy around these issues. And so we find that it's difficult to find companies that have business models that really are solving a problem for a customer that is a financial problem. So either helping them make more money or reduce their costs. It's typically kind of, hey, if you want to reduce your emissions, and in the very long term, it's going to help you make more money or help you reduce your costs because of the impacts of climate change. That's a little bit less motivating or less enticing for somebody else, another software startup that's not focused on climate change, to come in and say, hey, if you use our software, you're going to make 5x in your revenue in the next month. It's a little harder to make that sell. Hopefully that's helpful.
Yeah, and very relatedly, there's a question from someone who has an idea on water management. And there's potentially only one customer, which would be the South Florida Water Management District, which is a government agency. So this is actually kind of typical in the climate change space, I would say, that you work with public entities. The question is, have you ever heard of a situation like this? Can I proceed with only one potential customer?
That's a good question. So I would say if this one customer, well, I'll step back. The context in which I gave this presentation and the feedback I'm giving now, the answers I'm giving now are all from the venture capital perspective. Venture capital is only one type of funding source, and it has very high expectations for growth and fast growth. And so it's, all of the companies that you see in the news typically have raised venture capital funding, which is why it has become so popular. But that is not the only funding source and not the only way to run a business. So I would say with the venture capital hat on, only having one potential customer for venture capital is probably not the best way to go. But if you have a solution, it's going to work for this customer, and especially with more government or public entities, once you lock them in on something, they're typically going to pay for decades on that thing. And so if you're not trying to necessarily grow your business to, hundreds of millions of dollars in revenue, but you really have a solution that's perfect for this customer, and you can, you know, sustain your business just on the revenues from this one customer, then I would say go for it.
So the next question is from the perspective of data scientists who are looking for job opportunities in early stage startups. They have the feeling that the discoverability of such job opportunities is a problem, both for employers and prospective employers. Is there a solution? Do you have any recommendations?
I don't disagree with this. We, even with our portfolio companies, you know, data scientists are in high demand, but we know that they're out there, and particularly one of the things we help our portfolio companies with is leveraging their mission as a competitive advantage. And so when they're recruiting for data science roles, it's kind of telling people, you know, come work over here instead of going to work for Facebook because you're going to be doing good in the world. That being said, it's still difficult to kind of match all these things, hence why recruiting is such a big business. But I would encourage you to spend time either virtually or in person in the places where these early stage founders are going to be. So that's going to be at pitch competitions, conferences, and likely also at academic institutions. I think that that's where a lot of people search for early stage talent as well. And looking at, as somebody mentioned previously, kind of the time that people are hiring is right when they have raised funding. And so paying attention to kind of the venture capitalists or other investors who you're really aligned with, and you really like their mission and you like the types of companies they invest in, join their newsletters or otherwise pay attention to when they've invested in a new company. That's when they're going to be hiring people. And typically, or not typically, but sometimes these firms, these venture firms, have job boards for their portfolio companies. So that's another good place to pay attention. Hopefully that helped.
Okay, so the next question is, what climate-related AI-powered startup would you like to invest in that doesn't exist yet?
That is a really, really good question.
We wrote a paper on that. So
yeah, exactly.
There might be some ideas in there.
Actually, that paper is a really good resource. You guys, I feel like, highlighted very clearly. Here is a place where more research needs to be done and more solutions need to come to market, broken down across all these verticals. So that is definitely a good place to start. If I'm attacking this from a personal position, I've spent a little bit more of my time recently focused on the circular economy and also in kind of clean tech and distributed energy resource management. I'm really fascinated by both of those things. I think that there's a lot of data, especially, you know, on the circular, well, actually both the circular economy and clean tech side require a lot of interoperability across entities to really move forward in a good way. And that requires, and there's not good incentives to do that currently, and there's also not good platform technologies to do that currently. And so I'm really excited about those. I think that, what else? I was going to say something else, but I'm forgetting.
Maybe in the meantime, like, so many of the papers that academics write are proof of concepts. So taking something from the proof of concept stage to deployment is potentially a way to go about this.
Definitely. Yes. And if I think of any, I would say anything, try to build a startup that is drawing down or avoiding like up to 1 gigaton in emissions as much as possible.
So the next question is, how do you balance impact potential versus financial upside when you're choosing investments?
That's a really good question. So I'll start by saying we are a venture firm, and so we expect venture returns, meaning that we want to invest in companies that are going to return our investment by 10 times. And so really, again, kind of that really fast growth. With that, we also expect for the impact to grow in tandem with that financial growth. And so how we basically filter or validate that, the first is around the team. And so we really look for mission-driven founders, and it's pretty easy to tell when talking to someone if they're in it for the money or they're in it for another reason. One of the ways that we dig into that is talking about motivations and kind of, how did you choose to start this journey? What's motivating you to solve this problem? And a lot of times, some of the strongest stories come from a personal experience with the problem. And so, we invest in the health side. And so, I'm trying to solve this problem around access to healthcare for seniors because my grandparent really recently passed away and didn't have that access. So something along those lines. Climate change is a little harder because the individual impacts of it are more intangible. But I would say something of that nature. So, I've been studying this my entire life. This is a problem that I couldn't believe nobody's solving yet. And so I really felt like I needed to. The second is around really ensuring that impact is intrinsic to the business model. And so one example that we give of what we don't invest in is kind of Tom's Shoes, which I'm not sure if everyone's familiar with that, but it's basically the shoe company that said every time you buy a shoe, we donate a shoe to somebody in sub-Saharan Africa who doesn't have shoes. While I'm sure that is impactful to some degree, we know as investors that when things start to get tough and the company's running out of money, they're going to stop giving those shoes away in Africa because it's costing them money and not really giving them any financial return. So we make sure that every growth in revenue, every new customer is really increasing the impact of that company, either linearly or exponentially. And then lastly, we do talk about kind of impact metrics that the company will be tracking, making sure that those are also helpful for business management. And because if they're not, then it becomes clear that the impact is not intrinsic to that business model. So we don't, sorry, maybe I'll end that by actually answering your question, which is we look for both, and we don't accept less of either.
A very quick questions. Are you open to investing in India?
We, as you'll learn this as you engage with more investors, we never say no, but the answer is that potentially, but the bar is very high. It basically has to be like, it has to hit every other requirement we have for companies, and probably exceed some of the expectations that we have for companies that are based here in the US.
And kind of similar, other than the San Francisco Bay Area, do you see other hotspots in the US or in international locations that have lots of activity in development of climate change solutions?
Yeah, definitely. So I used to work in sub-Saharan Africa. I think that the potential of us leapfrogging a lot of these very harmful emission generating technologies is really high in Africa, because you can just build things better from almost the start. We invest somewhat there. We also look at one area we're really excited about currently is the electrification of our transportation system. Norway is kind of the highest density of electric vehicles per capita, I believe. And so like that's an area where we've seen a number of companies focused on that there, and have been somewhat interested, mostly in their transferability to US markets. China is also, I think one of the biggest or the highest volume in terms of electric vehicles. So that's another area we see that. For other climate change solutions, We've seen a lot in kind of both the energy space and climate prediction here in the US. I haven't seen too many that are outside, but that's probably because of my focus. I've also seen, as it relates to circular economy, the best companies come out from the EU because all of the policy mechanisms are there to push forward innovation in that space. There's a recent policy that's around extended producer responsibility, basically meaning that somebody who produces something is then also has to help with the figuring out the end of life for that product. And so there are all these companies that are trying to help bigger corporations figure that out. And we don't have that here in the US. And so we don't see the same things here.
Probably really related to that is a question on policies and how do you deal with the fact that climate change application can be highly driven by policies and especially policy changes. So a business case might not be there if a policy changes.
Yeah, it's a big risk. It's one that we try to stay aware of, but kind of, as I'm sure, well, I'm not sure actually, but I think my perspective on it at least is some of the biggest changes, particularly around climate change, are likely going to come, at least here in the US, from corporations. They're the ones who have the money to do this, that can create internal policies and kind of industry level policies that really push things forward. And so I think operating within those bounds is probably best than waiting for a policy to come to fruition. So an example, we have looked at a few companies that their revenue streams come from carbon credits and are really focused on those markets. We tend to not invest in those companies because that's something that isn't stable currently. It's not widespread. The policy is not here in the US to support that. And so it's a little too risky on the market side for us to really go deep or invest. And I would say that I really hope that is a future we all live in. And I think the investors who are able to take advantage of that change are going to be the ones who are really anticipating it at the right moment and investing in the companies that once, let's say, the policy does, become a reality, the companies that are going to potentially do really well in that are going to be ones that already exist. And so I think it's really about trying to anticipate that timing and making sure, like, for example, that we aren't going, signing up for the Paris Agreement and then pulling out. I think that we all know how detrimental all of that is to not only at the policy landscape, but also at the business side of things. Creates a lot of uncertainty.
So around the next question, there has already been some discussion. The question is, your investment metrics are oriented around a typical enterprise SaaS business, unlikely to make a dent in emissions. Are you open to more impactful moonshot plays, assuming the financial upside is still there?
So great question. I would agree. And just for anybody who's not familiar, SaaS is software as a service business. And so this is like what Silicon Valley is built around currently. It's just kind of all these softwares that you can subscribe to and make a lot of money from. Ours are built around that because we do focus on enterprise and B2B, and we do also invest in kind of capital efficient or more software data science type businesses. We hope that they still are able to make a dent in emissions. It might be less direct. We are interested in moonshot plays, but it is difficult, as someone mentioned, for a fund of our size to really be making large investments in new infrastructure, for example. And so one area I looked at recently or earlier this year was around the carbon capture use and storage, which I think is extremely interesting, is probably necessary moving forward. But where the state of that technology in the market is currently is there aren't enough companies or the companies that are still innovating right now are really around the hardware and the infrastructure of sucking the carbon from the atmosphere. Where we'll likely look at that space again is when there are enough of those players already, and we're going to invest in a software solution that's going to help them optimize their businesses. And so that's a little bit about how we approach kind of this enterprise SaaS as being a little bit more of platforms to accelerate solutions that might be a little bit more physical or tangible. I hope that makes sense. And yeah.
Okay, and the next question is, how many investors do you need to reach out to before you are funded in a pre-seed or seed stage?
That's a very good question. It's a numbers game, and it can be a lot. I've heard a whole wide range. I would say target 40 to 60, make a big list. You're not going to get 100% response rate. You're going to have some first meetings that don't lead anywhere. And hopefully you'll have a few that get to second and third meetings and then lead to investment. It's definitely a numbers game. It absolutely sucks. And I'm so sorry. The entrepreneur journey is so hard. And I have so much respect for anybody who does this. You're going to get so many rejections and all the time until you get one yes. And then you'll find that all of the investors who said no, once you got this one yes, are all of a sudden interested again. So it's a numbers game. Definitely try and remain positive as much as possible. But the more, the better. And I would say that also the more meetings you have, the more practice you get, the better you're going to get at this process too. And so even if the answers are no, it's kind of like interviewing, right? For jobs, you're still getting practice, you're still getting better at your pitch, and you're going to get feedback from those investors that can help you iterate and prepare for the future meetings.
Okay, and then there's a question, do you quantify environmental return on investment and make it transparent?
I really wish that we did more around this. It's really difficult with the wide variety of companies that we invest in across our portfolio. So, we do have this sustainable economies focus, but we also do data-driven health and adaptive workforce. And the impact metrics across all of those different companies are really hard to quantify anything, and also quantify kind of environmental return. The way that we do it with companies that do have kind of CO2 emissions avoided is we do our best to work with those companies to calculate what those are on kind of a customer by customer basis. And then we'll multiply that across how many customers they're able to reach. And we aggregate that to a portfolio-wide kind of report on how many CO2 emissions are avoided across our portfolio. We do that, and then we do number of people served, which is number of kind of end users or customers, and then we do jobs created by our companies, and those are the three metrics that we report on across our portfolio. I think you'll see this across the impact investing landscape, but nobody has figured out how to collect data on impact and report on impact in a good standardized way. It's still something that's being figured out by the industry. This large investment firm and their impact fund, TPG Rise, I believe created this separate arm. It's either called Y Analytics or Z Analytics, that's focused on trying to figure out how to measure impact. And their current strategy is to turn all of that impact into a financial dollar value. And that's how they rate their investments across the board. So it's purely a financial calculation from the impact side. And that's how they choose to move forward with an investment or not. So there's a wide range of how to deal with that. And we do not report that publicly. Sorry, we report that to our investors or our limited partners, but not too publicly.
Okay, we are nearing the end of the webinar. So we also have an entrepreneurship category in our forum that is targeted for these kind of questions that came up and further related question, and might also help to match people with similar interests. So please feel free to sign on to the forum, and there should be a category for these. And the recording will be sent out by email or put on our website. We are discussing that, but we will make it available and shareable. Okay. Thank you all for attending.
Thank you both to Alex and Lynn for putting this together. Really appreciate it. And for everyone for attending.
Thank you, Jessica.
All right. Have a great day.
Bye.